I hope you're achieving your property dreams and pushing as much as you possibly can this year to get more leads, more investors, more deals across the line. But I wanted to address something that I'm being asked quite a lot by the progressive community at the moment. You know, I'm one of the progressive approved brokers, mortgage brokers, and we're dealing a lot with not only startup new investors, but also we're working a lot with experienced investors. And one of the big things at the moment is around not only the BRR strategy, but also the BRS strategy, you know, buy, refurb and sell, buy, refurb, refinance. And the question is, can we use a mortgage, i.e. a buy-to-let mortgage or a residential mortgage, to be able to buy the property, do the refurb and then sell it? Now, there is a massive amount of risk on that, and it realistically depends how long you're going to be owning the property for. I actually run a Facebook group for mortgage advisors. I coach and mentor mortgage advisors on their business and on their lead generation and their marketing, and how to give better advice and that sort of stuff as well. So I put this to my group of 600 plus mortgage advisors and said, what are the outcomes of people who use a standard residential mortgage or a standard buy-to-let mortgage to utilise BRR strategies? And I got so many comments. I know a client who's been refused in the future for using a residential mortgage or a buy-to-let mortgage with no early repayment penalties and just paying it off after 4 months when the refurb's done. So you're looking at risks, something like lender refusal. You're looking at the lender that you go with, informing other lenders of what you're up to and what you're doing. You're risking, as a broker, as a mortgage broker, there is a massive risk that the mortgage broker could get kicked off that lender's panel, which is why we won't do it and why a lot of other brokers I know in the community won't do it. The mortgage lender, if you've got a residential mortgage and they find out that you're using it for investment related purposes and doing the refurb, could request for that loan to be repaid immediately. So you've immediately got to have a resolution to that. The other possible outcomes of a lender finding out that you're using their products is the loans being not only recalled, but also the early repayment charge, an early repayment charge being charged. So let's say, for example, you had a product which had no early repayment penalties. You do the refurb, you do the improvements, there could be a charge to you for utilising, for effectively, what's the word I'm looking for? It's not fraud. Not giving them the right information at the point of the application. I can't think of the word right now. But that could allow them, you've broken the terms of your mortgage offer and there's a risk. They might turn around and say, well, actually, we've given you a preferential rate, which is currently 2%, figures meaning nothing, examples only. That's not a rate that you're necessarily going to get. But let's say, for example, that initial rate was 2% that you're being given with no early repayment penalties. Not only could the lender do what I've already mentioned, they could turn around and say, well, actually, we're going to put you on our standard variable rate, which might be 5.5%, 4.5%. So all of a sudden, you're going to find your payments going from here to here. And also, it could be refusal to, future further advances or product transfers, because the big thing, if you're continually using a mortgage as a means to complete your BRR strategy, for example, then every time you do that, there's a footprint left on your credit report. So other lenders, if you do this 6 times in a year, lenders are going to know. Because when they go to do your credit check, they're going to be like, well, hang on a minute, he's applied for 6 other mortgages, or she's applied for 6 other mortgages. So there is a huge risk. And I know, depending on how risk adverse you are, is going to depend on whether you want to follow that strategy and you want to take that risk. Because yes, it is going to be cheaper. But the preferred method when utilising something that you want for short term, so you're buying the property, it's going to take 3 months to refurb, it's going to take 3 months to sell it, and then you're going to be out of it within 6 months. Or you're doing it for 12 months and you're going to then refinance it and get your money back out, pay your JV fund, or whatever your circumstances might well be. In doing that, you should be using some sort of short-term finance, i.e. a bridging loan. And there are products out there that will do a bridge to let. an immediate one-stop shop. We're doing that quite a lot for clients. So it's got less fees, there's less solicitor costs, and it can make life much, much easier. The other side of it is you can bridge with one lender and move to another lender. And one of the advantages of bridging loans is generally the mortgage lender will add all the fees to the loan. They will roll the interest up, which means that it doesn't cost you anything. It all gets added on to the mortgage. Now, at the end of the day, as I say, it's your choice in relation to whether you're risk adverse or not. But a very recent scenario that I'm aware of is a client had 60 properties in their portfolio. And because of utilising a standard residential mortgage, 7 years after ownership, when effectively they hadn't done a BRR strategy, they bought the property on a standard mortgage and then changed its use. They converted it from a 3-bed house to 3 flats, and they'd kept the mortgage. So they'd completely broken the terms of the mortgage, 60 plus properties. And what they did, they turned around and they took that mortgage from the rate that they were on to the standard variable rate. So whatever rate the beginning rate was, it went up to 6.8%. That is huge. Their payment went to £4,500. And where does that go? It goes on your profit. It goes on your margin. So it doesn't necessarily have to be the BRR strategy. You might be buying it with a standard mortgage and looking to do a conversion later, but you need to make sure that you have the right type of mortgage, the right type of finance, and there is that opportunity that the lender might not ever find out. But do you really want to take that risk? Do you really want to see yourself potentially being blacklisted from other lenders? If you're a mortgage broker and you're watching this, do you really want to take the risk that you might be struck off that lender's panel? If you want to do property investment and you're looking to leave that legacy and build that business, to give you the lifestyle that you want, to be able to have less stress, more time, more money, more freedom, then you need to make sure that you've got the right type of finance for the properties that you're going to be buying. So if you're buying a property with a view to perhaps convert it to a HMO or to a serviced accommodation, there are a couple of lenders out there who will allow you to do that on a no early repayment penalty product without necessarily using bridging finance. But this is why the approved broker scheme came about within Progressive. It's why I spoke to Rob about it in November 2018. Is to improve the level of advice that the community gets, and to make sure that you've got the right products, you're getting the best interest rates, you're getting the lowest possible fees, because all that's going to do is give you more chances of raising finance. It's going to give you more chances and opportunities in the future for deals, for better interest rates, to save money, to create more profit. So I hope that's been useful for you. I hope that massively helps. If you have any questions in relation to your property investment strategy, in terms of raising finance, in terms of what I've covered off with you today, if you've had an experience of any of the things that I mentioned at the beginning, lender refusing you for the wrong type of finance, informing other lenders that you've got the wrong product, requesting for the loan to be repaid, going from a standard rate to being charged an early repayment charge, or going on to SVRs, standard variable rates, then hit everybody up in the comments below, because it's all well and good just coming from my word as a broker who's been doing this since 2003, seen this firsthand, but for you guys to share with each other your experiences and people that it's nobody wants to be in a worse position. So I hope that's been useful. You're welcome to contact me and ask me any questions. You're welcome to put a comment below. Have a good day.